following program on Ada Derana 24 is classified for general audience. It is intended for all ages. It contains little or no violence, no strong language, and little or no sexual dialogue or situations.
A very good evening and thank you for joining us on this special presentation here at Ada Derana 24. We have a lot to discuss when it comes to the specific topic that we have been giving lots of updates about recently, but we haven't been able to have a sit-down conversation at full length about what it's looking like right now, and that's on the current status of Sri Lanka's economy. Now, I'm sure with the IMF program that's been going around, there's been a lot of information that has been coming to viewers as well, the audience, relating to what Sri Lanka's economic health looks like at the moment. But really beyond the complicated wordings and of course, you know, the reports that we've been seeing and the tranche reviews, what exactly is it looking like on the ground for Sri Lanka's economy? And to speak about this very important topic, we're someone that's not a new face on any of our programs, and that is Global Business Cycle Analyst Dr. Kenneth De Silva. Doctor, thank you very much for coming back to the studio. We have a lot to get into, so I believe you need no introduction when it comes to our show specifically. I want to start, Doctor, with just a general understanding for our viewers to get an insight into what Sri Lanka's economic health looks like, the macroeconomic situation, our inflation, our growth.
Sure.
As an individual that is consistently following up on this, what do you see right now in terms of Sri Lanka's economic health?
Sure. Thank you, Anuradhi, for inviting me. To kind of break it down in simple terms, the economy is in a state of flux. There isn't too much really going on in our growth story. Our growth story is fairly tepid. If you look at the numbers compared to our regional peers out there, and you look at Asia in general, Asia is growing at an average around 5% this year and in the next year. And countries like Vietnam, Philippines, India are in the region of 5+ percentage growth in terms of the overall GDP. So Sri Lanka is just meandering around a 3% mark. Now this 3% mark is nothing too exciting to call it, to be honest, because Sri Lanka during even the height of the war grew at around average 4.5%. So it is below our potential is the first point. The second point is, if you look at this whole exercise that we went into with the IMF, was to ensure that Sri Lanka's debt profile remains sustainable, because the IMF and people who were associated and worked closely with the IMF and carried the IMF message to Sri Lanka, a lot of think tanks who did that, was of the view that Sri Lanka's debt was unsustainable. Now, when you look at the IMF numbers itself, the ones which are released recently in July 3rd, 2025, that doesn't give any comfort saying that we are out of the woods. Our external debt continues to rise in actual numbers, in terms of US dollar terms. We eventually end up at around $65 billion by 2030. When we are currently around 35. So that's a concerning factor. Then if you look at our debt to GDP ratio, which was so-called unsustainable, still remains well above 100% right up to 2028, 102 plus. So that's also an indicator that's saying that we are not really out of danger as yet. The third point is, how do we finance this? Now, while IMF has clearly shown a roadmap in terms of external funding, our internal finances, particularly the external balance sheet of Sri Lanka, is not in a good position at all. Now, these are worrying signs for the Sri Lankan economy, particularly from my point of view. When I look at it and I look at the balance sheet of Sri Lanka and their income streams, I am actually very worried, because we are relying purely on two key components in our overall revenue streams, which is the tourism piece and the private remittances piece. Now these two are key components of our cash flow, and they are not really something that a country should really rely upon, because the sensitivity to external shocks is huge. We have seen that back in 2019 when tourism revenue dropped to about $500 million. Now it's back to about $3.5 billion. That is gross figures. Remember, there's tourism figures that you see in the daily news and in the central bank press reports are gross figures. The outward tourism is also there. So our net figure is pretty much lower than the 3.5 billion that we are talking about. Net outflows, net tourism, outward tourism is about $1 billion. So the net result in the overall tourism surplus, cash surplus, is about $2.5 billion, because Sri Lankans travel abroad, and that also contributes to the overall outward flow. So that whole story kind of worries me in terms of our overall cash flows that Sri Lanka has to generate, and therefore, to come back to your point, in terms of the situation, I am quite concerned because I don't see really the growth drivers that can take us from where we are to a 6-7% type of growth, not in the near term, particularly given the IMF framework that has ring-fenced our ability to do anything apart from stay the course.
Exactly, Doctor. What you mentioned is very importantly at the end there, the tunnel vision that we see when it comes to agreeing to certain agreements like we have with the IMF. There's a lot of caveats that are involved. Yes. I wanted to ask you specifically now, of course, the overall picture we see is slightly negative and worrying. When it comes to the solution that the IMF is touting that we are able to receive through this kind of program, which is at the end of the day debt sustainability, I wanted to ask you, relating to now, there's the short-term benefits and the long-term repercussions. Can you explain to us and emphasize a little bit just how drastic the difference is between whatever short-term benefits we might be able to see with the IMF and what long-term repercussions or issues that could arise down the line? Because as you mentioned, 3% growth is negligible compared to our neighbors and our peers. Sure. When it comes to our economy. So what can we expect with the end of this program as well?
Yeah, so the short-term is also relatively sketchy, while the long term is even more scary, to put it lightly. The short term, we don't have any sovereignty over our fiscal and monetary policy. That has been completely taken out from the government and the people of this country. Everything has to be endorsed by the IMF, including any fiscal incentives. We have seen in the IMF program itself, they want us to repeal or to amend the Strategic Development Act, which was enacted for people investing in the port city. Now, while some may argue saying that that is a good thing, to me it leaves a bad precedence, because once you start tampering with set fiscal policy incentives, both local and foreign investors are taken aback, because these are tax holidays given for various projects. They themselves have to be vetted now by the IMF. There are 24 projects that have been approved by the Port City Commission. According to the IMF report that has been published recently, they categorically state that these projects have to be run past the IMF and vetted by the IMF, which means that we don't have any sovereignty on the fiscal side. So with that type of arrangement, we are handicapped to support any kind of industry, leave alone attract foreign investment, which is the need of the hour. So while that happens to the investor side, the real economy also suffers, because we can't incentivize any of our local industries, or neither the SMEs who are actually at breaking point. And also remember that the SMEs are a key part of the overall national balance sheet, and which account for about almost 55 to 60% of the overall throughput in the balance sheet. So they themselves are in a dire situation. The external investors looking at Sri Lanka now get mixed feelings. Local investors who have already invested also are now contemplating moving out. Plus, we have, on top of that, we have industries that are now subjected to a global tax regime, which is the Trump tax regime that has been imposed. So all these significant cash flows that are supposed to strengthen the national economy and within the national balance sheet are under stress. So that's the shorter term. The longer term of this fallout is that once you have this in motion, you lose market share. For example, if we start tampering with the, as we've seen with the apparel industry tariffs, and not only apparel, but the overall export tariffs that are now being imposed by the US in terms of the incremental taxes that the Trump administration has posed, that has multiple sectors from fisheries to gem and jewelry to apparel, plus a couple of other sectors, including minerals. So these sectors also will get impacted. And once we lose market share, the industries that are located in Sri Lanka will move out for tax arbitrage. They'll relocate. One or two things happen. One is they'll relocate, or companies will shut down because they can't absorb that taxation that is now imposed. Because if you look at the apparel industries, their gross profit margins are around 5 to 6%. So the current imposition of this tax regime will change that whole thing, and some of these will become unprofitable. That is number one. Number two, we are also one of the largest exporting industries is the apparel industry, with about $5 billion gross, because the net value is a little lower. Despite that, we are now moving back away from the overall fiscal policy that we had, where we had a set-off VAT, or it's called SVAT. So at the point of imports, you pay. At the point of exports, you set it off. Therefore, exporters don't have any cash flow stressors on their balance sheet. Now, we are repealing that, which means that at the point of imports, you pay. Once you export, the government will then review the appeal, and then there is a process. You have to submit it to IRD for you to get reimbursed. Now, the time that will be taken from the point of import to the point of export, let's assume it's 60 days, you've got a working capital requirement for the local companies. So their working capital requirement will increase, their funding has to increase, their cost of finance will increase, and therefore if the government doesn't pay on the 60th day, then they've got further penalties that will come in. All this will add up into their overall earnings, and their overall retained earnings will drop. And when shareholders see retained earnings dropping, they don't want to stay in this country. They want to relocate. So these are the types of fiscal constraints that have been imposed, where we are looking at longer term, greater structural imbalances, greater structural dangers for Sri Lanka's revenue generating sectors. So that's the kind of summation I can give you in a nutshell.
Exactly, and that is just the very basics, the essentials of it. There's quite a lot more that I wanted to get into as well. And there's this question I wanted to ask you relating to debt sustainability in itself, if we really are through this program moving towards it. But we do have to go in for a short break. Before that, Doctor, I wanted to ask you, now we recently saw a report that was released that you just mentioned. I want to have you walk us through some of the key indicators in this report that we see when it comes to Sri Lanka's assessment via the IMF. Is it alarming? What do we see right now?
Well, I mean, to me, those indicators are actually quite disturbing. I mean, that's the only word I can kind of come up with. Because as I said, 3% growth right up to 2030. I mean, incrementally there is hardly anything that you will get out of this for you and me. Because remember, GDP is nothing but the reflection of revenue that the country earns. So if your country, so we are at a 90 billion or I think $95 billion economy. So 3% on that is what you will get, right, each year. I mean, that doesn't really translate too much in terms of what the end individual will make, right? So his or her income is a reflection of that revenue stream that will come in. So ultimately, the benefit of that has to come to the people of this country. Now, if profit compressions take place, as I mentioned, that 3% is not going to cut it because our debt servicing is increasing, as I told you, debt to GDP, and our overall composition of debt is also changing. We are moving more into external debt financing, right? So, which is the danger, which means that our national balance sheet, which has two currency compositions, we have got a rupee balance sheet and we have got a dollar balance sheet. We are not paying attention to the dollar balance sheet, we are just focusing on the rupee balance sheet. So we are trying to generate sufficient rupee income to service dollar debt. That becomes extremely vulnerable to exchange rate movements, right? We have seen that in 2022, the rupee depreciation alone added nearly $1 trillion in incremental debt servicing. $1 trillion. Right now, where is that trillion going to come? It has to come from you and me. So people who touted, based on the IMF's precondition, to free float the currency, have completely ignored this incremental debt servicing that has come out. Remember, there is a translation risk. What is a translation risk? A translation risk is your balance sheet liabilities are in dollars, your cash flows are in rupees, because you collect rupee taxes, you don't collect dollar taxes. Therefore, you have to collect rupee taxes to service your dollar debt. Now, when the exchange rate moves, that rupee component is not enough. So for for $1, you have to pay 200. Now you have to pay 300. So that incremental 100 rupees has to be obtained from local taxation. When a country is already suffering, right, from the compression of revenue, an incremental cost being pushed on to the consumer and to the businesses is unbearable. So the rupee movement is a significant anchor that we should mess about, and people who spoke about this, saying that we should have a free market-based exchange rate, have missed this particular point. That is number one, and that is a critical part in terms of our overall debt. Number two, the state-owned entities like Petroleum, CEB, Water Board, Sri Lankan Airlines have huge dollar liabilities, including some of our corporates. Now, they too face a similar irony. But the worst part is when you see losses accruing as a result of the exchange rate movement, those hit the P&L of these state-owned enterprises, and what do we do next? We shout, privatize. Not understanding the implications of the exchange rate movement on these SOEs. SOEs, debt stock gets revalued. They have to raise extra financing from the banking sector, so they go to the two state banks. State banks' working capital financing increases because they have to now finance the state-owned enterprises, and therefore money supply in turn increases, right? Because your working capital requirements have gone up. Banks have to finance that working capital. When banks have to finance that, they go to the central bank and borrow money from the central bank, or base money increases. And therefore, the aggregate money supply also increases as a result of a movement in exchange rate. So these are the dangers, and then people cite that and say inflation. So obviously when the exchange rate moves, because we import so many goods and services, and our balance sheet is naturally skewed towards greater liabilities and assets, which actually is confirmed by the central bank annual report. If you look at it, the national balance sheet, if you took the assets and liabilities, we have net liabilities. And our net liabilities continue to increase year on year. So in 2020, we had about 48 billion net negative liabilities, or net negative assets rather. In 2022, we have got about a 50 billion net assets, negative assets, and 23 and 24, it's much more high. It's around 54 billion negative net assets. So as you see the trajectory, we are moving into more debt, more external debt. So that's the biggest danger that I see, and we can talk about it more after the...
Exactly. I want to specifically get into the disparity that we see when it comes to financing our external debt as well, and if honestly there is a hope of actual debt sustainability, and what this touting is relating to, how this program can help us with that, when we already see that the actions that have been taken are only leading towards more liabilities that are occurred to the internal processes of the country. Before any of those specifics, I'd like to go in for a short commercial break. You're watching Special Presentation. We'll be right back after this. Welcome back to Special Presentation. We're in conversation with Global Business Cycle Analyst Dr. Kenneth De Silva. Thank you very much, Doctor, for the previous segment. It was a lot of information, yes, but a lot of necessary foundational understanding for what kind of situation we're at right now when it comes to the program that we have been put in. You mentioned a lot of handicaps that have been involuntarily or maybe subsequently just, have been placed onto certain key liquidity generating areas of Sri Lanka's economy, despite there being a lot of emphasis and focus on, no, this is going to be a positive impact upon the future of our economy. I want to delve more into what we were just discussing relating to the report that we saw as well. And now that the new tranche has been approved and that financing is also going to come into the country. Before we get into more of the technical specifics, I wanted to ask you about the entire aspect of debt sustainability, because that is the key reason as to why we have decided to stick to this specific, after multiple tries, this specific program of the IMF. Will it work out for us in a positive way? I know that right now the indicators don't look too good, but are we genuinely able to actually achieve proper debt sustainability when it comes to this program?
Well, I mean, to be honest with you, if you look at the IMF report itself, it doesn't tell you that. It doesn't give you that sense of confidence. So rather than me saying it, the IMF itself says it in indirect sense with the indicators showing that we are moving to unsustainable territory right up to 2030. So that's the first point. The second point is, if you look at, for debt to be sustainable, there must be, like I said, the external balance sheet must show signs of improvement. And if you can only show that by showing the sources of income that can be generated. Now, if you look at the IMF numbers itself, the overall current account still remains negative, right? Not the trade account, the total current account itself is negative, right? The last 2 years, I think 22 and 23, we turned it into a positive because of contraction in the economy. We ring-fenced the economy, we kept import restrictions. Now, as per the IMF agreement, you have to liberalize this. You can't do that. So the first step the government has agreed, it has been signed off in this last agreement to liberalize trade, particularly vehicle imports. And as you saw that taking place. Now that spillover is about $1.8 billion more in incremental external financing, which is not partly in the cash flows now, but it will eventually hit the national accounts, and then the whole is going to be bigger. Now we are anticipating tourism incomes and private remittances to bridge this gap. That's why I said there is huge stressors on this, and that's the most dangerous part. Leave that aside, the trade imbalance is still there, right? The trade imbalance is what's driving this whole story, and trade in terms of goods and services are important to Sri Lanka, because if you look at the services sector, the IT sector contributes about $1 billion gross. Now, out of that billion, there is about 300 million that is spent on various software licenses, software procurements, etc. So net is about a $700 million surplus that we have. Still significant in relative terms to some of the export items that we have, as close as probably TT is about $1 billion, so we have 700 million. Net is still fairly decent. Now, if you are thinking of growth pillars, then this taxation that has come on to the IT sector is dangerous, because these are services which can be moved rapidly. I mean, particularly on the BPO end of the spectrum, the KPO is a different thing, and the software development. But ultimately, the skill set are transferable, right? In the sense that if Sri Lankan software developers are not getting paid the relevant package or the remunerations, they can move elsewhere. And that we have seen happen, so that knowledge outflow could materialize once this starts to kick in, probably end of this year, because it's in October, I think. So that's the second point. The third point is, again, what are the industries we are going to create to generate external revenue to pay our debt, right? Not very clear at the moment, because industries need state to intervene and support, and also to give them incentives to compete globally. Otherwise, you will not be able to compete in terms of price and product. So that's a huge disincentive, because we don't have, as I told you, fiscal space. We don't have the luxury of doing that, and including giving some of the apparel sector the necessary relief. We can't do that currently. I saw some analysts saying that, oh, it's $40 million. You know, if you give US the go ahead to an import from the US and taking out the para tariffs, the para tariffs itself will cost the country about $40-50 million. It's peanuts. We can easily do that and narrow the trade deficit with the US. Now, the danger in this is, one is we have to recover that $40-50 million again from local sources. So that's the question. Secondly, when you narrow the trade deficit, that means the surplus that we have in that account is going to reduce, and therefore our trade deficit will widen, because there will be more imports from the US, while I don't think the US is going to really start moving to take a larger share from Sri Lanka, because under the most favored nation agreement, there are multiple countries who come under that umbrella, and they can export to the US. So Sri Lanka doesn't have that luxury of increase in market share in the US, just because we reciprocate by enabling more imports into Sri Lanka. So that debate is, I mean, easily manageable. So the key point is, where is our revenue? And if we can see clear external sources where we can get this revenue to mitigate the external borrowing, to mitigate some of the bonds that we have already issued, which are coming up to maturity, they have to be serviced, and also they have to be paid. That's the scary point. And remember, these bonds are also macro-linked bonds. I don't think people understood this. Macro-linked bonds are linked to your country's performance. No sooner your GDP growth rate picks up, the coupon rate increases. So if your GDP remains lower, at that lower end of the spectrum at 3, then you get that concessionary coupon rate, which means it's another trap. So if you don't grow, you're incentivized. If you grow, you're penalized. Technically, your coupon rate increases. So
Catch-22.
Catch-22.
So that's a very important area I want to actually get some information on now. GDP-linked and governance-linked bonds. When it comes to such instruments, as you mentioned, it is a catch-22 situation. How exactly has it in any way tried to reduce our future risks? Do we see? I mean, is it just, as you mentioned, swapping one set of vulnerabilities for another? Are we really in hot water when it comes to these kinds of situations?
It seems so. I mean, that's my whole premise in this particular program. For me, it's worrying because I don't see our external industries having the capacity to go and compete and gain market share. If we are to gain market share, we need to identify key industries like what many of the small countries have done. If you take Singapore, they said, okay, we are going to focus on oil and gas and logistics. They went for it. They identified a niche. Estonia, great example. I think they started to move only in around 2000. 9 million population, they had, I think, a per capita income of about $1,700, $2,000 in 2000. And today they're at a 35,000, 31,000 per capita. They wanted to be the most attractive destination for investments, and you could open and set up accounts. So they went into this e-governance and e-procurement and entire on the digital side, where you could set up company in a day, right? And so it attracted a lot of attention, and investors came in. Likewise, Denmark, right? And many of the small countries, including Netherlands, right? So all these are countries with 5-6 million population, right? So these countries identified a clear strategy and they went with it, right? Now Sri Lanka, we still don't seem to have a clear industrial plan in place. We had one back in the 1980s, just when Premadasa kind of took over. Thanks to him, we have President Premadasa's initiative of 200 garment factories. We still have the luxury of having apparels being sent to the world, even though it has consolidated from that point. So that was one industrialization strategy that we adopted. Prior to that, of course, Mrs. Bandaranaike also had an industrialization strategy. I must mention that in the early 60s. We did relatively well compared to our peers at that point in time, and then President Premadasa. And finally, we saw President Mahinda Rajapaksa also move into an industrialization type of environment where he created the space for industrialization and for industries to come into Sri Lanka, but we didn't follow through on that. So we lost that opportunity. Right now, having said that, the world has migrated to industrialization 6.0. What is industrialization 6.0? Is in global industries have become completely autonomous. From ports to manufacturing, from logistics to transport, everything is autonomous. No human intervention. So the cost of production in those countries is highly capital intensive. The cost of producing an output now comes down significantly because these factories are running 24/7, unlike Sri Lanka, where we have still a labor-intensive manufacturing process. So that will take time, but there is opportunity in that whole space. Because once these countries start to industrialize at a rapid stage, the lower industries which are not that great in those countries move out, like what you're seeing in the apparel sector globally. So Sri Lanka has space to pick these industries up and develop these industries, get the knowledge transfer, and move from there, like what China did in the early 1980s. But Sri Lanka is not ready to do that. Sri Lanka doesn't have a policy framework, neither do we have the fiscal or the monetary space to attract investors into Sri Lanka, and that's where we are stuck currently.
That's very unfortunate, because I want to ask you about the most favored nations agreements as well, and how we can see if maybe diversification. We have had this conversation before, but I wanted to reiterate it through you as well and re-emphasize if that's where we should go and what our future plans should look like when it comes to dealing with these nations that already have autonomous industries that have significantly less labor costs and far better production rates than Sri Lanka currently has. But before we get into specifics relating to that and what alternatives and future readiness that we can see, let's take a very short commercial break. You're watching Special Presentation. We'll be right back with the final segment. Welcome back to special presentation. We're in our final segment in conversation with Dr. Kenneth De Silva, Global Business Cycle Analyst. Thank you very much, Doctor, for the previous two segments. Unfortunately, we are running out of time. So I want to ask you, I think, the most important question that I believe our viewers would have right now. And that is on if right now, with our current framework in place, with the IMF program not really faring as well as we would have expected it to for our country, what then? Because of course, I mean, the IMF program will happen, it'll finish, and then maybe they will tout certain figures and, you know, economy statistics saying, oh look, we have seen some progress, this is what we expected down the line. But at the end of the day, it comes down to the people living in this country to actually survive with the economy that has been handed to them through this kind of program. So when it comes to what other alternatives we can look at moving forward as well for future readiness, in your perspective, with your understanding of this entire situation, what can we expect for Sri Lanka moving forward?
So, I mean, in terms of the alternative, we have to take it from the US itself, what Trump is doing. He's thinking Hamilton, acting Hamilton. And for those who don't know the gentleman by the name of Hamilton, Alexander Hamilton was the, I think during George Washington's time, he was the first Treasury Secretary who started the US industrialization journey. Now, he did a couple of things which also Trump is doing. He slapped tariffs. He protected infant industries, and he got manufacturing back into the US. I think a few years back when I watched a Bloomberg discussion, I think they were contemplating whether they should go back to Hamilton policies during the Biden administration. Now Trump has come back and he's going full out in terms of implementing a similar framework which worked for the US now at a global stage and more at a more kind of visible manner than what it was there in the early 19th century. So Sri Lanka, whether we can follow a similar practice, doubtful, but we can learn from them. What I mean by that is manufacturing is the future, right? Digital currencies are the future. Sri Lanka is missing out on that. Trade is now being settled with digital currencies. US has brought in an act promoting digital currencies because they're worried that the Chinese may take that particular factor. So the world in commerce and investments have changed. Now US wants international data centers being located, and I think they have gone and wooed the Middle East to bring in, I think, more than $2 trillion in setting up these data centers. Now these data centers are highly energy driven centers. Now, Sri Lanka doesn't have that luxury, so we can't even think of putting up a data center because energy prices are so high and we still have only one coal plant, right? And we don't have a second coal plant, even though coal is relatively cheap than other energy sources. They're stable, whereas if you go into solar, it's more different. So the alternative energy mix is something that we have to be really mindful if you're serious about industrialization, because ultimately the bottom line to business is the profit story. No business is going to come into Sri Lanka to do charity, right? If we have that mindset saying that we are the most attractive country and we don't give any incentives, I mean, you will see what has happened to FDIs. It has not shifted too much. And that FDI component is not going to change anytime soon because we don't have that luxury of giving any fiscal incentives, tax holidays, allowances, capital goods allowances, depreciation allowances. We don't have that luxury because we are driven on a particular target. Our income has to be 15% of revenue, GDP. Revenue has to be 15% of GDP, and we are focused on that, and we have to have a surplus in our current account surplus, right? So to do all this, we are focusing our energies on these two areas, which is dangerous. So the alternative is we have to move away from this particular program in some shape or form. Now it's a little too late to think of an alternative because we are too far down the track, and any deviation will warrant significant wrath from the external donor community, plus the external financiers. So we have to stay this course until 2028. 2028, we can probably relook at it because the IMF final tranche is in 2027. And then we might have to reassess because the world is changing. With BRICS coming up significantly, there is an alternative in the BRICS type of framework. Whether or not Sri Lanka is ready to embrace that is something that we have to see. If we do embrace that, and if we can manage the geopolitics around that, then I think the industrialization framework can be woven into this particular kind of pathway and journey that we want to take. Others, we have got really no hope in, kind of becoming a nation with which surpasses the middle income trap and get back into that 15,000, 16,000 per capita bracket. There is no way that you can do that. The only way you can do it is through industrialization, and that's the journey for Sri Lanka ahead.
Exactly. Professor, Doctor, unfortunately, we have quite a bit more to discuss, but we've come towards the closing moments of this discussion. Before we end off this conversation, I believe I'd like to get from you your comments relating to what we can expect moving forward in this program, and not just that, the best and worst case scenario that we might be able to see for the country once in 2028 as well, as a sort of final remarks relating to this entire topic.
Well, 2028 down the line, it really depends on what we want to do, as I said, in terms of our country. We have missed out on several occasions. Whether we'll miss out again is something that we will have to see, because that economic policy can't be set in isolation. There is a political leadership that has to come in, and the political leadership must be crystal clear in what it wants to achieve. With these two aligned, only that we can get out of this middle income trap. And to me, I'm waiting to see some leadership in this area so that we can carve out our own national journey based on a strong national balance sheet, because the government has to, and its responsibility is to create growth in revenue. And revenue comes by creating external competition, where our industries, where our companies can compete on equal footing at product level, at price level, to capture external markets. Only if we can capture external markets through building strong entrepreneurship, building strong companies, strengthening their balance sheet, empowering them, giving the necessary inputs, giving them necessary financial support by way of subsidized loans, giving them the necessary support by way of fiscal stimuluses, taxations, right, where they can use those incentives to capitalize their balance sheet, to make their balance sheet strong, and also to get more technology into the companies so that they could compete. Only with that framework, once we have that ability to compete globally, classic case is what I told you was Dilma. Dilma is the only Sri Lankan brand out there that's competing on a global stage. We don't have any other significant brands at that level. There may be other brands, but at that global stage, we don't have any. Right? If you see the other countries, if you just do a quick Google search and you look at other countries, you will see the amount of brand names that are being created out there. So these brand names capture market share. That market share translates into revenue. GDP is revenue. No sooner you have that revenue flow open, then if you start competing, then we have a greater possibility to have a GDP growth rate of about 7 to 8%, because we are a small balance sheet still. We are still $95 million. It's a small country, small balance sheet, and there is enough of upside room. As I said, the balance sheet size has not been quantified. Our national balance sheet is not confined to what we see now, because remember that we have an exclusive economic zone of 517,000 square kilometers, which is untapped. We have mineral resources which are untapped. All those valuations form part of our balance sheet, including state-owned enterprises, central bank assets, financial sector assets. All these assets, if you sum them up, right, and you do a future cash flow projection, you will find that Sri Lanka has significant opportunity to capture global market share.
Lots of untapped potential that hopefully we'll be able to utilize in order to maybe rise above the current situation that we see with the projection of our country, hopefully for a more positive outcome. Unfortunately, Doctor, we have come to the end of the time allotted for us for this discussion specifically. Thank you so much for coming down to the studio once again to explain this very vast area and for us to better understand and digest what kind of situation we're at when it comes to Sri Lanka's economy, because it concerns every single citizen that resides in this nation. Well, that's all we have for you tonight on Special Presentation. If you had missed any of our programs, you can always rewatch by catching us on our YouTube page, youtube.com/otherderana English. Thank you very much for watching. Have a good night.